If you're a business owner, I can guarantee you've been at the same place that I've been in my career. You look at your profit and loss and it looks fine, but you still feel like cash is tight or maybe profits disappearing. Chances are your P&L is lying to you. In this video, I'm going to walk through the 5 most common P&L mistakes that I see as a fractional CFO, and then how do we fix them so we actually know what's going on in the business. So I'm Roman, I'm the founder of Full Send. We help 1 to $10 million businesses owner get clear, confident, and in control of their finances. Yeah, those P&L mistakes, we've seen all of them, and we've also seen them cost businesses hundreds of thousands of dollars. So we want to make sure that that is not you. All right, so what is the first mistake when looking at the P&L? Number 1, we see that there's a heavy mix of cost of goods sold with overhead. So what does that mean? You have costs coming into your business. Maybe that's inventory or maybe that's labor hours that are cost of goods sold. Now what happens is that those often get categorized into your operating expenses, which means your gross margin becomes kind of meaningless. You don't actually know how much money you're making on the services you're delivering or the product that you're selling. So what we want to do is look at our direct costs, look at our labor, look at our materials, look at shipping, and move those into cost of goods sold. We don't need to worry about complex allocations at this point in time, but we want to look at operating expenses like rent, software, other administrative salaries down into operating expenses. If you can segment out your operating expenses from your cost of goods sold, you will have a better picture as to the margin that's being driven in your business. And when I talk about gross margin, I'm talking about the money that's left over after you collect your revenue, you deliver your services, and there's money left over to fulfill the operating expenses necessary to continue growing your business. Now, the second mistake that we see most common is that businesses aren't using classes, departments, or categories effectively. Meaning a lot of businesses have different business lines, maybe different geographies, or different ways in which they should be slicing and dicing their financials to understand the performance of their business. You can't really see what products, teams, geographies are profitable if you're not segmenting your revenue, your expenses according to the various departments or categories in your business. So what do we do here? In all accounting softwares, you generally have the ability to turn on class tracking or department tagging in your accounting software so that you can track more specifically what expenses are going against which location, what revenue is generated by which department, to enable you to look, like I said in the first mistake, at the margin that's being driven by these various categories. That will help you make better decisions as a business owner to know where and how to invest the dollars to generate a return on the products or services that you're offering. The third biggest mistake is that we often see owners' compensation buried in operating expenses. So why does this matter? Well, we're trying to figure out the true cost of running the business. And you're really underestimating the true cost of running the business because you're bearing your own compensation and operating expenses. So what are we trying to do here? What we want to do is we want to separate out owner's draws, guaranteed payments, S-corp wages into a clean category outside of your operating expenses. Now, note to single member owned LLCs or LLC partnerships, you can't take a wage, and so all money that's going to you will be in the form of a distribution that is on the balance sheet and actually not in your P&L at all. So we want to make sure that we have separation here of owner's payment from the general operating expenses in the business. The fourth most common mistake we see here is reporting on a cash basis when strategic decisions are really requiring of accrual basis financials. So a quick sidebar on this, cash basis is a methodology of accounting that means when transactions come into the business, you are recognizing that transaction at the point in time in which the cash is received or the cash is outlaid. So if you generate revenue, you're not actually recording that revenue until you receive the accounts receivable, the invoice being paid from your customer. If you sign a contract for payment for the next 12 months, in a single lump sum up front, you're actually recognizing that entire expense at the point in time which you pay for that contract. Now, accrual basis is saying we actually want to recognize the revenue according to the service period, over a period of time in which we're delivering services to our clients. Or on the expense front, we want to recognize the expense when we're incurring it in the period in which we're actually utilizing the services that we're paying for. So for instance, if you sign a 12-month agreement with a software vendor, you pay for that upfront. In an accrual environment, you will be recognizing that expense equally over the next 12 months and not just on a cash basis in that month that you pay for it. So why does this matter? If you're reporting on a cash basis, you're making decisions based on timing and not performance of the business. What often happens, back to mistake one again on the gross margin, is that you're actually seeing a really lumpy swing in gross margin based on things like payroll, big expenses that are made, and or timing of revenue fluctuation in your business, not actual performance on how your services or products are operating in the market. So in order to get a really good picture on how to make decisions relative to performance, you really should be looking at your financials through an accrual lens. Now, what's the last mistake we see often? Mistake number 5. A lot of people tend to ignore trends in their business. They're really only looking at their financials 1 month at a time, or maybe even 1 year at a time. So what happens when you're not looking at trends that are occurring over a period of several months, maybe a quarter, or the last 6 months? You tend to miss patterns and miss seasonal shifts that, if caught earlier, might have saved you a lot of money or led to another revenue outcome that you didn't see coming. So we want to be looking at our business over periods of time, looking at accounts that are trending over time. So for instance, if you're investing in sales and marketing, we don't want to just look at what the sales and marketing spend was last month relative to budget. We actually want to look at it over the course of the last 6 months to determine whether or not that investment was worth it. There's a lot of ways that you can analyze your financials and elicit trends from the financials, but you really need to look at that over a series of months and a series of time rather than just 1 month at a time. So ultimately, your P&L should be a power tool. It shouldn't be a puzzle, right? You want to clean it up. You want to structure it right. If you're like me, you want to be reviewing it regularly. You want to be involved in the numbers. And I promise you, as a business owner to business owner, you will be making smarter and faster financial decisions. Whether you go in and take a look at some of these mistakes yourself and start cleaning things up, or you work with a partner to do so. If we can be helpful to you at all, send us a note. Happy to chat. howdy@thefullsend.com. I hope this was a helpful overview on mistakes that we see in P&L all the time in order to help you build a more sustainable, profitable business as you go through 2025.